cover sustainable investing. How do you balance performance and climate action in your portfolio? So what we're going to go over today is we're going to start at a super high level. We're going to look at divesting from fossil fuels and reinvesting in the solutions to solve climate change. Is it financially smart? We're going to look backwards, see if it was. We're going to look forwards, and then see what's coming up. Then we're going to transition into just at a super high level, how to be a smart investor. This is someone who you're just like, I should invest, but I'm not like super into the details. I just know I should. What are some strategies that we suggest for our clients and that we try to build our portfolios around? And then we'll move into the landscape. We'll say, how do you apply this? How do you be a smart investor to investing in climate change? We'll talk about what is the impact of your investments? How can your investments help accelerate us towards that world where we stabilize climate change? And we'll go over what are the existing options today, what are the ones we like, where are the shortfalls, what are some ways to evaluate those options today with some free tools. And then we'll talk about how we do it at Carbon Collective to wrap things up. So if that all sounds good, let's dig in. My co-founder and I, that's him here, we go way back. We've known each other since we were 4 years old, and we started Carbon Collective because we wanted to make it simple and safe as a way to invest in solving climate change. And that's because we need a lot more money invested in solving climate change. Right now in 2020, we had about $500 billion, which is like a ton of money going into things like clean energy, mitigation, stuff like that. But we need a lot more. By 2030, it is estimated that we're going to need $1.6 trillion investing around the world annually in just clean energy alone. And that's why when we set out to build Carbon Collective, our theory is that we needed to make climate-focused investing be smart investing. Because for you to feel comfortable investing something like your whole IRA, your financial needs are really important, and you can't forget about those. And so that means for us, we wanted to create something that was low fee, diversified, and market tracking, and had a really clear and easy to understand impact. So we built our portfolios and we back tested them. We could look all the way back to 2015 and we saw like, all right, we like pretty well hit this. This is our portfolio, our 80-20 against a blend of the US 80-20, just the benchmark there. And what we can see is like it fairly well tracked the same rises and falls, very similar performance from 2015 all the way through January 1st of 2020. But then it stopped tracking it. And especially after the coronavirus crash back in March of 2020, that dip in that rise, we saw our portfolios pretty significantly outperform. And this just led us to the question of why. Why did that happen? Why did we have this kind of, we were market tracking, and what trends can we learn here? And so that's where I want to start with these mega trends that if you signed up for this, maybe that was something that drew you in for this webinar. So let's dig in. And let's start by looking backwards. What would have happened if you had divested from fossil fuels? How would your portfolio have performed? So we actually have data on this. And the data comes from this guy in his firm. Jeremy Grantham is one of the most famous investors of all time. He's known for calling bubbles. And I bring this out up front to show that this is where we get the data from, because like he's not like at Greenpeace. Like he is an investor. He believes in climate change. But that's where this data comes from. And what they did is that they looked backwards and they said, okay, we have data all the way back until 1925 to look at what would have happened if you had divested from your fossil fuels from your portfolio. How would that have performed? Because there's this narrative that fossil fuels are really important for returns in your portfolio. And if we go all the way back to 1925, we could see that, okay, like it would have performed a little bit worse than the overall S&P index. It would have performed about 0.05 percentage points worse. So back going from now until 1925, that's actually a fair amount of money. It's like $100,000 difference because just compounding interest is insane. And $100 invested then would be $2.5 million today. When we start, what's interesting is as we start getting closer to the present, potentially as we're starting to see more climate change take effect, we can see from 1957 to 2017, it's similarly, energy is removing energy, fossil fuels, performs less well than the S&P 500. But from 1989, the year I was born, until the present, divesting from fossil fuels would have actually outperformed the overall S&P 500. And then looking just up until now, so this is up through August, so this is the past 10 years, this is from August 3rd, 2011 to August 3rd, 2021, fossil fuels have really not done well. You can see them here in blue. This is the energy index. If you had invested $100 at August 3rd, 2011, you would have actually lost money at this point, where that same investment in the S&P 500 would have more than tripled at this point. And so looking back, we're seeing this trend that as we're seeing climate change start to rear more, the market is losing some confidence in fossil fuels, and we're starting to see that. So that's looking backwards. But what about looking forwards? And this is where things start to get really interesting and exciting. So we believe that we are in the middle of a technological transformation, and that these things can happen really quickly. I love these pictures. So this is in New York City. This is on Fifth Avenue in 1900. And look, it's all horse and buggies. And here's the one car. 13 years later, same thing, Easter morning, all cars, one horse and buggy. There. These things happen quickly. And when we have technological disruptions, they don't happen linearly. They rise into an exponential. And this is kind of a classic S curve. And what happens is you have a new technology, let's say like the automobile in this case. You have a new technology, you have the early adopters who are using it. And as they start using it, they're like, wow, this is way better. Because like a car is better to get you around than a horse and buggy. Like it doesn't poop, you don't have to like rest it, you can just refill it. Because it's better, that leads to more investment in it. And that you get more public acceptance of it, which leads to more investment. Because there's more investment, you get more government support, there's higher revenues, and you start having it taking over. Where you have on the old system, let's say the horse and buggy in this case, there's less demand. So like the stable shuts down, and there's less investment. People are like, the buggy manufacturers are like, I don't know if we should keep making buggies, and they're not going to put as much pressure on the government to like keep making buggies, and so that there's less supply of it, and so it gets more expensive even to buy a horse and buggy, which makes buying that car even better, and you start to have this exponential growth curve. And for us, what it seems like is that the technologies that are solving climate change, we are on this same curve. And so let's dig into that. Fossil fuel use in the US is the majority of it is going to two sectors. It's going to transportation, and it's going to power. So 31% transportation, and 28% electricity. So let's start with transportation. What is happening in that space? We're seeing a technological disruption. Electric vehicles, similar to that the car was to the horse and buggy, they are just better and cheaper than their counterparts. In the vast majority of emissions of fossil fuels that are used, you'd think like, oh, we talk a lot about airlines. No, it's actually our cars and trucks. It is light duty vehicles, with the second largest being medium duty and heavy trucks that are for long haul truckers. Aircraft is actually only 10% of the emissions that are used from transportation in the US. So there's this big chunk of the pie where this new technology is coming that is better. And it's better because electric cars, they are faster, they are more powerful, they have way less maintenance. They cost about half the same to maintain because they have fewer moving parts. They have more features, like this electric F-150. Maybe you've started to see the ads for them, but you can literally power your house and power outage from them. And they're also way safer. It's their center of gravities are a lot lower. They don't have engines in the front that that could crush you in the event of an accident. And here is this is a picture of a Ford F-150 setting a record, towing 1 million pounds. So electric cars, by their just sheer technology, they're better. And already today, their lifetime cost is comparable. This was put together by the New York Times, and you can see that electric cars have the lowest cost in emissions over their lifetime, here with the Nissan Leaf being in this corner in terms of the average cost per month. So right now, they're still more upfront, but all in, they have much lower fuel costs, and they also have significantly lower maintenance costs. And they are soon going to be cheaper to buy. Bloomberg estimates that by 2027, the upfront cost of an electric car versus a gasoline or diesel powered car is going to be comparable. So it's going to be the same amount for something that's a lot better. And that's what makes it unsurprising that we're starting to see that type of growth. This is when we go back to that S curve, this is that type of exponential growth where we see this starting. And this is part of the problem of it tends to actually be pretty hard to spot when we're in these S curves, because humans, we don't think on exponentials very well. We saw this with COVID. We tend to think linearly really well. But we're seeing this transformation now into just something that's a lot better. So that's that first big sector that is changing, that big mega trend. And the second one is in our energy. And here it's that renewable energy and batteries. They are cheaper and similar to electric cars. They are growing exponentially. So this is a pretty crazy stat. Since 2009 to 2020, solar went from by far the most expensive form of energy to now by far the least expensive form of energy. And wind is what's behind. And what this is leading to is that fossil fuel plants that were built are actually being used way less than projected. This article on coal plants in India, that they were projected to be used 85 to 90% of the time that during a day, they're actually only being used about 55% of the time, because there's just like cheaper solar and wind during that time. And so they're like, the utility saying like, who do I want to buy from, the cheap one or the expensive one? And they do the cheap one, which is solar and wind. And that what's crazy is that it's happening really quickly. This study, which we really liked, looked at the total cost of a new solar and wind plant is already below just the operating cost of conventional generation, such as gas, coal, and nuclear. That means that if building a conventional power plant costs nothing, the upfront cost, the capital cost is nothing, it is still more expensive based on operating cost alone than a solar or wind plant. Because for solar or wind, you just build it once, and then the operational costs are incredibly low. And so in the same degree as we saw with electric cars, we're seeing that same type of takeoff, where we're not looking at something that's linear, but we're actually looking at something that's more of an exponential. And we're seeing that's going to lead into that S curve in that replacement for electrical generation. Overall, I like to end with this. On this point, is that just in general, renewables have the economic tailwinds. Unlike fossil fuels, which get more expensive as we pull more of them from the ground, because extracting a dwindling resource requires more and more work, renewable energy is based on technologies that get cheaper as we make more. So renewable energy, we can get that technology from something we're really good at manufacturing as humans, and getting to economies of scale and dropping that price down and down, whereas fossil fuels, it's just we have to go further and further afield to find it. So we're in a similar S-curve there. And finally, that mega trend of what's happening is just that, and we talked about this at the beginning, is that we're seeing climate change. It is here. It is incredibly hard, but it is happening around the world, and that our changing climate will change markets, because a warmer planet is just simply bad for business. It means that there's less predictable crop yields, there's more damage to critical infrastructure, there's rising insurance costs, the real estate market is less predictable, we are spending more GDP on disaster relief, there are more lawsuits, and there's greater political instability because of it. For us to avoid catastrophic warming, fossil fuel production must plummet by 2050. Our oil production must drop by 75%, coal by 90%, and natural gas by 55%. So these are all industries that are in decline, and they need to decline further. And that the final risk here is that just when that pain is bad enough, legislation will come. And thanks to groups like CCL, we're trying to get it to come as quickly as possible. And so holding those fossil fuel stocks and those companies that are dependent upon fossil fuels, they have significant risks in extreme changes to their bottom line from that type of legislation. Carbon tax, lawsuits, stranded assets, and the end of fossil fuel subsidies could significantly shake up those business models pretty much overnight. So overall, when we look at fossil fuels going forward, the megatrends are that they are being outcompeted in transportation, they're being outcompeted in electricity, and they are soon to be outcompeted in the remaining sectors because of the legislation, because of these, and then the legislation it has to come. So let's take a step back to the side and talk about, what does it mean to be a smart investor? This is a question that we get a lot. A lot of people come to work with us because they're like, all right, I know I should invest. It's a great way to build my savings or save for retirement. That's going to beat inflation. And I can invest in companies that I feel really good about, but I don't know how to be a smart investor. I don't like picking stocks and being on Robinhood. So here's the three principles that we say to everyone to remember, and it's how we build our portfolios. The first principle of smart investing is that go passive. So there's two types of funds that you can buy out there, mutual funds and ETFs. The first type, they're active. These are managed actively by fund managers who are like, all right, we're going to roll up our sleeves, we're going to do a ton of research, and we're going to buy and sell stocks. And as the market changes, we're going to try and beat the market with that. And we're going to charge higher fees because of that, because like, hey, we're doing a lot of work. The other option is passive investing, where they're saying, all right, we don't really know which stocks we should buy. We're just going to buy a sample of all of them. And it's just going to track the market. If the market goes up, we'll go up. If the market goes down, we'll go down. It's not that much work, so we're not going to charge that much. Looking back at the data, there has been no point where actively managed mutual funds or ETFs have been able to consistently, 5-year period, outperform passive in that regard. So if you choose an actively managed fund, you might beat the market, but you might not. It's often those higher fees. They will cut into any of those gains. And so this is from S&P, that almost 78% of funds underperformed the S&P 500 over the past 5 years. So just choosing passive, invest with the market with as low fees as possible. The second thing is to diversify. So that's a great thing that you can do in passive investing. You kind of are automatically diversifying in stocks if you're doing that, buying something like the S&P 500. But a strong portfolio doesn't have only stocks. This theory, modern portfolio theory, which came out in 1952, showed mathematically that you can actually have a portfolio that you will get more return for less risk if you diversify. And so let's look at this. Let's say you're like, I want to be uber conservative and I want to have a portfolio of all bonds. And so this is based upon the bond returns data and the stock return data of the S&P 500 from 1977 to 2011. If you had a portfolio that was 100% bonds, you're like, I want to be as conservative as possible. The amount of risk you'd be taking on is about 9% in volatility, and the amount of reward you would have gotten is about 9%. If you had instead said, all right, I'm going to do a portfolio that's 75% bonds, so still highly conservative, but 25% stocks, you would have actually gotten more return for less risk. And that's because those two assets are lowly correlated with each other and even negatively correlated. So you want to have in a portfolio, you want to put together assets that have low correlations with each other, which means that if one goes up, the other one might go up, or it might even go down. And it's a way of preserving some capital in your portfolio. If that one, let's say like most of your portfolio goes down, but if the bonds go up, then you have more capital preserved going forward. And the final step is to rebalance your portfolio. So generally, if you work with someone like Carbon Collective or pretty much any investment advisor, they're going to set up a stock and bond portfolio that is a combination of stocks and bonds. It's usually percentage based, so it'll be like 80% stocks, 20% bonds. That is going to be a more aggressive portfolio where you're probably going to see more volatility because the stocks are more volatile, and bonds tend to be less. When you set that up initially, let's say you choose an 80-20, it will change over time. Let's say the stock market does really well, like it's done over the past few years. That initial 80% that you had in that portfolio, that value will rise. And so it will actually change to be, maybe it'll kind of be like, oh, now your portfolio has more like 90%. This is where rebalancing comes in, where at some regular interval or at some point, you want to have a mechanism where you'll actually rebalance it. So you'll get it back to 80-20. So if the stocks are a lot higher, you'll sell some of the stocks and buy some of the bonds to get it back to 80-20. And the math really shows this. From 1974 to 2014, $100, this is the blue line with no rebalancing invested. You could see it didn't perform nearly as well as $100 that was rebalanced. So even the 60-40 account was one of the best performers. When it was rebalancing, it was almost a $200 difference, over a $200 difference in this case. So those are the three. Invest passively, diversify as much as possible, and have something to rebalance. Usually an investment manager will do the rebalancing for you, and it's one of the valuable things that you get. So that's how you be a smart investor. But let's talk about, you want to apply this to your values. You're probably here because you believe that it's important to invest with your values. So let's talk about like why. Why does that actually matter? And the first reason is that it does, even in small ways, help out those companies. So when you buy and hold the stock of a company, especially if you have it for something like your retirement account, you are effectively removing that share from the supply of shares. So when something that's good that happens to that company, it means that there's lower supply of shares and there might be a lot of demand for it. And it will help that share price rise, which can then help that company raise more money to do things like build out green hydrogen infrastructure around the country. This is something that fossil fuel companies have done really well. They tend to give really high dividends, which means people put them in their retirement funds, which means that they're effectively keeping those stocks out of the market. So we want to see the same thing happen with the companies that are solving climate change. So that's the first way that we have impact. The second way is voting. Our economy, the stock market, is kind of a really weird form of democracy. And we as stockholders in these companies, they are publicly traded, which means that they are responsive to their public shareholders. And so there is increasing movement to vote against management and force companies to do things that are maybe against management's interests, but for the greater good. A hedge fund that we're big fans of called Engine Number One did this recently, if you heard about it, with ExxonMobil. They actually got 3 directors voted onto their board that are maybe they're not the most extreme climate activists, but they believe that climate change is real and that Exxon needs to do something about it, which is really huge. They were able to build a coalition against management. The third thing, and this is maybe the most important, is narrative. So I want to spend a second on this slide. The Dow Jones US Coal Index, it fell 99% from 2011 to 2020, 99%. And that's not because we stopped using coal. We still have a lot of power plants that use coal around the world. We're still mining plenty of it. It's not a good thing, but we still are. It is because that the narrative for investors became that coal, this industry as a whole, there was no longer growth opportunities within it. And so therefore, investor confidence in the industry as a whole collapsed. And that led to a hastening of its eventual demise. It made it a lot more expensive for coal companies to raise money, that cost of capital, because they didn't have that investor support. And looking at narratives like what I showed earlier about those megatrends, that is one of the ways that us, the people that are on the vanguard here, who are looking at climate change, they're seeing how bad it is, and we're seeing the future of what it could be. This is a narrative that is really important for us to push forward because we can drive the same thing. We can turn oil and gas into the new coal because it is. It is drying up. And then the final thing, which I touched on at the beginning, is closing that gap. The clean energy investment gap, investing in our climate solutions. There is more coming. We are accelerating, but we have to move faster and do that. So that's why investing in a way that is climate friendly and climate focused is really important. We talked about how to be a smart investor, and now let's go over where are the options for doing that. Can you be a smart investor who cares about climate change and want impact? So this is the landscape as we see it. There's kind of 3 categories of funds that are out there. And we're focusing on funds that you could go out and buy. These are ETFs in mutual funds. So we categorize them by green funds, climate funds, and ESG funds and portfolios. And so the green funds is a great place to start. Their impact is clearly positive. We are helping fill that clean energy gap. Largest solar ETF, global clean energy ETF, the US clean energy ETF. So you're owning those companies, you're helping their cost of capital, you're not having that money in any industry that is necessarily harming climate change, we're helping it. The downside is that they're really expensive, so we're not getting that low fee of being a smart investor, and they're not very diversified. So it's not a good place to put say your whole retirement fund, because you're gonna see a lot more volatility. You're not getting that broad diversity for being a smart investor. The second option, there are more climate-focused funds. These tend to be a little bit more broad. They're still fairly expensive. There's a lot cheaper options out here than this, and their impact is mixed. Etho is an ETF that we really like. What they do is they look across the stock market, and they pick the companies in each sector that are in the lowest quartile for carbon emissions. Really cool. It tends to be more focused on mid-cap. Change Research looks at the 100 largest companies in the US and takes out the fossil fuel companies. Also good. Aspiration, they're a green focused bank. They have a mutual fund. We're not very big fans of it, unfortunately. We've in digging back through it, it's unclear how they build their portfolios, and we've seen fossil fuel companies in it, like Berkshire Hathaway, which owns multiple fossil fuel companies. So the final option here are ESG, and then we've also included this voting funds. ESG is a framework that is very popular in the financial space right now. It stands for environmental, social, and governance. And it is a way that firms like Vanguard will hire analytics firms to go out and rate all these companies on all these different criteria, and they'll kind of build these average scores that, like, all right, they get let's take like Chevron, it could get like a 2 on environment, but it tends to do really well on social and governance, so it gets like an 8 and a 7 on that, and then they'll average it. And so then they'll put it in here. And so ESG tends to be a good way of excluding the worst of the worst. So their impact, they can still have fossil fuel companies in them. So their impact is pretty neutral to negative in terms of having that level of exposure, but you are cutting out the worst of the worst. One fund that we want to call out here, which is really cool, Engine Number One, the same company that did the Exxon Mobil voting. They have an S&P 500 fund, which is just the S&P 500, but where they're voting very specifically. So you get pretty broad access to the market. It's still, you're exposed to a lot of fossil fuel companies. So you're holding them. Their theory of change is that you vote with them. It's a bit different than our theory of change, which I'll get to, but if that's something that appeals to you, it's a really good option. So let's dig into how can you evaluate a portfolio from a climate perspective. So Betterment, they offer a climate impact portfolio, and they put that together with a series of ETFs. They have 4 stock ETFs. So they have this one, which is the S&P 500 Fossil Fuel Reserves Free. They have this one, which is which is largely European stocks. They have this one, which is largely emerging market stocks. And then this fund, which is a low carbon target ETF, which is pretty similar to ETHO. They then have 4 bond funds. They have an inflation-protected bond, a municipal bond, an emerging market bond, which is really interesting, and then green bonds. We're really big fans of green bonds. They put your money to work directly in projects from companies that are specifically for climate action. So it's largely renewable energy, but then also cleaning up other things like methane leaks. So we really like this free tool. It is a great one, fossilfreefunds.org. At Carbon Collective, we try to only use free tools because we think you should be able to double check all of the data. So here you can go and enter the ticker of pretty much any mutual fund or ETF that is out there. And so we looked at this one here. We looked at all of these, but let's look at SPY-X, this first one here, this S&P 500 fund. And as you can see, it's not great. It's got a C. It's got plenty of oil and gas companies. And the overall carbon footprint of the fund is 62 tons per $1 million invested. And that's not different from the overall carbon footprint of the S&P 500 itself. It's about 65 tons, the S&P 500 per $1 million invested. And you're still exposed to things like Berkshire Hathaway, which again has multiple fossil fuel companies, Duke Energy, one of the biggest owners of coal plants, and a bunch of other very heavy coal utilities. So, all right, not great. What about on bonds? I noted this for the purpose of being a smart investor and hitting that aspect of diversity. Betterment made the call to include emerging market bonds, which is really head scratching. And that's because when we break this down, about 85% of it is government bonds. And which governments? They're very fossil fuel heavy. Qatar, Turkey, Saudi Arabia, Russia. These are governments whose governments are very dependent upon fossil fuels. And then here, the other 15%, agency, when you're looking at bond funds, agency just means company. It's about half of that, so 7.05% total, is made of companies that are fossil fuel companies, like Petróleos Mexicanos, which is, I don't know if you remember, that fireball in the middle of the Gulf of Mexico that was about a month back. That's that company. So like really not great in a climate impact portfolio. So when we go ahead and look at what is the percent fossil fuels, what is the carbon footprint in all of these in this climate impact portfolio, we see that despite the name of climate impact, the percent fossil fuels is still, you have a lot of fossil fuel exposure. The carbon footprint overall is really not that different than the S&P 500. And there's no exposure to the companies that are building climate solutions. It is just less bad. It is a slightly more divested portfolio. And the worst part is that you're still paying more. You're going to be paying more for that than you would for a generic Wealthfront or generic Betterment account. So we built Carbon Collective because we think that we need something better. So I'd love to take a few minutes to talk about how we build portfolios and how we think about the stock market and investing in climate change. So I'd like to start with our theory of change. And it comes in 4 parts. The first part is that ethical pressure on companies can work. So there was a study looking at what happened in wake of the Black Lives Matter protests of 2020, and that following Floyd's murder, U.S. companies pledged $50 billion towards racial equity. Okay, that's great, but if you don't have a seat at the table, it's just words. But the firm says that since then, only $250 million has been spent or devoted to a specific initiative. That's 0.5%. So it's critical that you need to actually take a seat at the table with these companies to not only apply the initial pressure, but to hold it there until the demand is actually extracted. The next thing is that companies are very unlikely to kill their golden goose. This is where we differ from engine number 1 in that they're applying pressure to fossil fuel companies. We think we need as much of that as possible. That's great. But if we only have a certain number of activist points that we can spend, where are we voting? Where are we putting our pressure? Let's not focus on fossil fuel companies. It's really hard to get them to change their core business in a stock market that operates on quarterly returns. Instead, let's focus on the companies who are their customers. Let's focus on the companies who don't depend upon fossil fuels for their core business, who could switch to 100% electric fleet, who could switch to 100% renewable energy and keep selling the same product in a way that is undisturbed. Let's do that. That's where let's focus. Which leads us to, what are our goals for collectivizing our investments together? Why did we launch Carbon Collective? We want to own and pressure the largest brands, take a seat at the table and build that coalition on shareholder resolutions and be there to enforce the follow through. By doing that, we want to reduce fossil fuel demand. So focus our efforts on pressuring these companies to switch to 100% clean sources and socially reward those that do. And then overall change that narrative, educate investors large and small on how fossil fuels, oil and gas, are the new coal, and we're having this technological disruption so get on and enjoy the ride. To do that, this is one of our most popular core portfolios. So we build it, about 18% of it is invested directly in companies that are building climate solutions, and I'll talk more about that in a sec. A lot of it in the stock portion, the rest of the stock portion is just in the low carbon parts of the economy that are the companies that we can put pressure on to switch to 100% clean sources. And then our bonds are made up of a combination of green bonds and US Treasury bonds. So let's talk about how we got there. We start by looking at the entire stock market. And when we look at the US stock market, we can see that 85% of emissions comes from these 4 sectors. So we divest from the carbon heavy fossil fuel dependent sectors. And when we look, these 4 sectors, their size in the overall stock market isn't that big. It's around 20%. So we just cut them out and we invest directly in the remaining sectors. So that gives a portfolio where we have that smart investment. You're getting broad diversity and exposure with a bunch of stocks in a way that's low fee. And these are the companies that can sell their core products using 100% clean energy. So the companies that we're primed to be able to pressure. What this removes completely, because we're cutting out the sectors, is utilities, oil companies, weapons manufacturers, coal companies, etc. A lot of these companies that are dependent upon fossil fuels. We then do a little bit more. We clean up the low carbon sectors. So from consumer staples, we remove cigarette companies because they're just evil, and the meat production companies. In financials, we remove the big banks because they are some of the largest financiers of fossil fuel exploration, and then also Berkshire Hathaway, as we've mentioned. So that's the 20%, but what about this part that we cut out? For that, we divest, and then we reinvest that amount in the companies that are building climate solutions. We call it the climate index. And there was not a collection of companies of every single company that was building solutions to climate change. So we wanted to put it together. If, and I imagine some of you on the call are familiar with Project Drawdown, it is the collection of over 100 solutions to climate change. We found and continue to find every single publicly traded company on US markets that is building solutions to climate change. We buy them, and we buy all of them. We cut out the ones that make more money from products or services that are serving the fossil fuel industry. But aside from that, our filters are quite wide. And so we're not choosing which solar company is going to win. We're investing in all of them, and then balancing them based upon market cap. And so that's how we build our stock portfolios. And then for bonds, 40% of them are green bonds, and the rest of them are a range of US Treasury bonds. And that's because we could not find a corporate bond fund that did not have fossil fuel bonds in it. Bonds are a place where we need a lot more innovation in this space, and we're going to be updating our portfolios as we go. So overall, this leads to portfolios where, again, we have about 18% is directly supporting owning the stocks and holding them of the companies that are building solutions to climate change. The rest in our core portfolios are the companies that we need to pressure to transition as quickly as possible away from fossil fuels. And then the bonds are split between green bonds and US Treasury bonds. We also have an option that for some folks, they're like, I just want to invest in the climate index. So we have an all green portfolios, only hold the climate index and green bonds as well. Overall, we're fans of our portfolios because we believe we've hit what it means to be a smart investor. Our portfolios are diverse. They're inexpensive. You'll pay the same in overall fees basically as you would for a generic Wealthfront or Betterment account. They're historically market tracking, obviously up until this point here at the end. And we're building them for impact. So overall, and we're just right at 40 minutes here on the dot. To summarize, investments can be a really powerful tool of change. We talked about the whys, the narrative, voting, cost of capital, and the need for more clean energy investments. Looking back, divestment was a financially neutral strategy, with it seeming like it has gotten a worse, or divestment has been a better and better strategy. Owning fossil fuels has been a worse and worse strategy as we've come closer to the present. Looking forward, it is very likely a financial smart one, especially if you divest and reinvest in the companies building climate solutions. It's currently hard to find smart, climate-friendly ways to invest, and that's why we're collectivizing the power of our investments by making climate investing be smart investing. So here are the disclaimers I'm obligated to show you. The one thing I always like to call out is that past performance does not guarantee future results. So with that, I very much look forward to your questions. Thank you.